A very well-known analyst, Anmol, is now joining us from JM Financials at the sidelines of their conference. We, of course, will be getting a lot more details what happens over the next 2 days. Anmol, let's first start with conference. You met a lot of investors. Anything about pharma that people are asking, the sort of trends you're seeing globally where Amazon is trying to sell a lot of products online, what's happening in India? What essentially do you get a sense when you talk about these disruptive trends in the pharma sector?
Yeah, hi, good morning, Pankaj, and thanks for having me. So basically, it's still early days. Our conference is just 3 hours old, but it's obviously begun on a good note. What we've seen so far is that, hi, can you hear me? I think I've lost them.
Okay.
Yeah, we can hear you.
Hi, can you hear me?
Yeah, Anmol, we can hear you. Go ahead.
Hello. Yeah, okay.
Yeah.
Okay. So what we've seen in terms of investor feedback is that people are looking for tangible earnings delivery. The hope of a better tomorrow seems to have exhausted itself, given that for past 3 years, a lot of pharma companies, especially on the US side, have underperformed. People are also trying to get their heads around the fact that there are a lot of disruptive trends, especially with a lot of online platforms, etc. And we had one of the leading online platforms tell us how the model intends to disrupt some of the more traditional frameworks. The road is going to be uneven. There are challenges with respect to logistics, etc. But as happens to be the case, a lot of startups seem to be addressing that opportunity. So yeah, I mean, in terms of pharma, as always is the case, there is an interesting part of the equation, which is US, which seems to be on a decline, while as domestic, which is increasingly profitable with growth having returned. If you look at some of the earnings print of leading major pharma companies recently, then you could make a case that that profit pool will also be attacked by these disruptors. And basically, the first half of the day was trying to understand how this disruptive model is going to impact pharma companies and whether there are any new opportunities which get thrown up along the way as a consequence of these massive changes in the traditional business models.
So, when we talk about the FDA issues, and about the US business, so what's happening, Anmol, is that a lot of these plants are now getting converted into warning letters. Now, this is a wave that we also saw in 2009 to 2010, or probably slightly ahead of that. Do you think once again the FDA issues have started, compliance norms have changed, and companies will have to invest a lot more into these and adjust to these new changes before growth starts?
So I would break it into two buckets. If you look at the pharma sector's evolution, every time they move to a next growth level, there is the burden of greater compliance. So FDA warning letters, 483s, change and tweaks in their processes seem to be a part of that journey. So I wouldn't get overly perturbed by the fact that FDA is coming more often. It is a part and parcel of the fact that India is getting more integrated into the US supply chain of generic drugs. So by the way of data, when we had done this analysis some time back, that India doesn't get any more warning letters than the generic volume that it supplies to the US as a percentage of overall warning letters or regulatory interventions. FDA has made certain changes. They've become very big users of artificial intelligence. There are efficiencies which have been brought in. So while you would have seen that the regulatory incidents seem to have increased, what has improved for the better is the response times. So if you go to the earlier regime of 2013-14, if you had a 483, then you had to wait for 4-5 months before you heard back again from the US FDA. But now that's happening rather rapidly. Similarly with the approval process, if you look at the approval process of various drugs, that timeline is also getting shortened. And also as a part of the process, regulatory oversight is increasing. One thing to bear in mind is that FDA guidelines and processes have become way too granular. And in the medium to long term, that is better. Because companies know exactly what to do to fix, to be on the right side of the compliance framework of various regulators. So if you define what you expect companies to do, then companies also come back and defy, because the cost of being out of compliance is way too high, because you lose windows of opportunities where your drugs could be making supernormal profitability, and by the time you're in market, you're already the third or fourth entrant, which has completely diminished the profitability opportunity that you once envisaged. To answer your question on capex or investments that companies will have to make to be in compliance with the US FDA, well, I think that in terms of capital investment, there's not a whole lot left. Indian companies have already moved significantly along the investment pathway on compliance. Most of the processes which could be automated have already been automated. What it will require, though, is some kind of a culture shift, and the smart ones are already working on it and are some pathway down that journey.
Right. Also, just wanted to understand about the diagnostics sector. In the last 3 or 4 years, this is one sector where there have been a few listings. Some of these stocks have also done well. Any picks over there? Anything you like in that sector?
So structurally, we are very positive on the space. Obviously, it's always a question of what price points you're comfortable with. These stocks have had a very good run in the recent past. So obviously I won't get into that, but the fact is that diagnostic offers a couple of things. One is that this is one sector which is at the intersection of retail, healthcare and consumer, with characteristics of all three, from a consumer behavior and a market demand standpoint. More interestingly, from an investor standpoint, there is very little capital requirement. So you have companies which have scaled up. And third, if you look at the return ratios of these companies, they're high. So they lend themselves to expensive valuations. But the path or the market opportunity for a lot of organized diagnostic chains, when I talk about organized diagnostic chains, I refer primarily to Lal and Metropolis, two companies we have coverage on, have fairly a long runway of growth ahead of them. Again, there will be bumps along the way. It is not going to be 15 to 20% without interruption, as has been built into some of the analyst models. But medium to longer term, I think this is one area which will continue to grow and will benefit from the shift of both unorganized to organized space, as well as greater healthcare penetration in tier 2, tier 3 cities. And we have some very interesting companies who are trying to tap into that.
Okay, thanks a lot then, Anmol, for joining in with your very interesting perspective on the pharma space. This certainly was a very interesting and knowledgeable conversation.